Okay, guys, so welcome to today's session. So this is FAQ 4864. So this is the second session on foreign operations. So what we're going to do, we're going to do part B of part 1 of this paper. This paper is test 4 2019, FAQ 4864. So we're going to do part B of part 1, which is just completing or fixing up the journal entries. Now, we have already read through this question. On Thursday, we read through this question, so you can watch the lesson on Thursday. What we did not read through is part 3. So part 3, this is the part we need to work through today, where there was a change in ownership. So remember, just a quick scenario, a quick background on the scenario is that we were given the group accountant kind of completed the consolidated trial balance. However, the only thing that the group accountant could not do was bring in the foreign operation. So his trial balance, his consolidated trial balance as at 31 March 2019 is basically correct, except for the fact that he did not bring in the foreign operation. He did not know how to do that. And we did that. Okay, so what we did, we brought in the foreign operation. Now, remember what is happening. We are running the financial, we are running in part A, when we did the question, we needed to do the statement of financial position, the equity section of the statement of financial position as at 31 March 2019. Now, as at 31 March 2019, that's the end of a financial year. This company, the foreign operation, was acquired during the 2019 financial year, which happened on 1 April 2018, which was the beginning of the financial year. So that is why we dealt with, there was no messy businesses over there. It was a simple acquisition of a subsidiary. The only thing we needed to deal with really was the foreign exchange adjustments. Okay. Now, so what we did the analysis of equity up until 31 March 2019. Now, part B is dealing with number 3 over here. So this highlighted blue is point number 3, and point number 3 deals with the question of part B. The question of part B is asking us to correct the journal entries or to process the correct journal entries. What happened in part 3 at 30th June 2019, which is in the 2020 financial year, there was a change in ownership. The change in ownership resulted in us losing control. So we had control of the foreign operation at 85%. We sold some percentage, and that resulted in us losing control. And the loss on control changed into significant influence. So we went from a subsidiary to an associate. So that's what we need to fix up. So the whole point of this journal entry is only dealing with the effect of the change in ownership at 30th June 2019. Okay, so that's basically the overview. So now we will read the scenario over here, or we'll read the information in point number 3, and then we're going to deal with doing the correct journal entry. So they say Thriandris is the managing director of AWTY, appointed by the employees that owns 40% of the issued ordinary shares of AWT. The Employees Trust held their annual general meeting on 2nd May 2019, where it was resolved that it was not beneficial for AWT to have and pursue interest in education and training in other countries. On 30th June 2019, through the persuasion of Theandra, AWTY resolved to dispose of 31,875,000 shares in Endgame for a cash consideration of 149 million rand. Okay, so the cash consideration, and as AWT exercised significant influence over the financial and operating decisions of Endgame from that date. So as you can see, on 30th June 2019, what happened? We disposed of some shares, and the disposal of the shares resulted in us going from control to exercising significant influence. That means we went from a subsidiary to an associate. The fair value of the remaining interest was 75,000 rand. So what we're going to have to do, so they're telling us the profit for the period from 1 April 2019 to 30th June 2019, for that 3-month period, amounted to 13 million, excluding any foreign exchange differences on the loan. Okay, included in the draft workings prepared by the group accountant is the following incomplete journal entry with regard to the disposal of Endgame on 30th June 2019. So he has investment in Endgame. So that is basically investment in subsidiary of 31,125. We'll see how we got that. I don't know how we got that. Okay, we'll have to have a look. Again, on disposal of interest on separate, what do you call it? We have 17.6. Then we have group loss on disposal. They have 36 million. Then they say profit for the period, 1 April to 30th June is 21.33. And then retained earnings, the opening balance on 1 April, it is 11,097. Okay, so they're saying consolidating the amounts during the period when Endgame was a subsidiary. Okay, so what's happening over here? What's happening over here is the following. We need to prepare the journal entries as at 30th June 2019. The question you need to ask yourself, what happened on 30th June 2019? So the big event on 30th June 2019 is that the change in ownership took place. What is the change in ownership that took place on that day? It's basically where the AWT's interest in Endgame went from control to significant influence, meaning it went from sub to an associate. So because we lost control, we're going to have to do the losing of control journal entries at that date. So at 30th June, we're going to have to get rid of Goodwill. At 30th June, we're going to have to get rid of NCI. At 30th of June, we're going to have to get rid of net assets. Okay, so get rid of Goodwill, get rid of net assets, get rid of NCI, because we lost control. As a result of losing control, we're no longer a subsidiary. If you are no longer a subsidiary, you can't have Goodwill relating to that subsidiary. You can't have the net assets relating to that subsidiary, and you can't have NCI relating to that subsidiary because you no longer have a subsidiary. Okay, so that's the one aspect. Then we need to recognize a gain or loss on the disposal from a group perspective. Okay, so we have to recognize a gain or loss on disposal from a group perspective. So we will see, but it looks like we made a loss over here. Then the other thing we need to deal with is that in the separate financial statements, the AWT, the parent, in their separate financial statements, they may have recognized a gain or loss, and we're going to have to remove that gain or loss because we don't want a gain or loss from the parent's perspective. We want a gain or loss from the group perspective. Okay, so that is basically the issue regarding the disposal. Then we need to recognize the new investment. Okay, so remember, the new investment is going to be an associate, so we're going to have to recognize an investment in associate. So that's all that we're going to have to deal with at that date. So we're going to, so the two issues, we're going to get rid of a subsidiary and we're going to recognize an investment in an associate. To get rid of a subsidiary, we're going to have to get rid of NCI. We're going to have to get rid of, what did I say, net assets. We're going to have to get rid of goodwill and then recognize a gain or a loss on the disposal. Okay, so just take note of that. And it seems that the gain or loss on disposal of, from the parent perspective is also over here. So we're going to have to get rid of that as well. So it looks like the parent made a gain. So in order to get rid of the gain, you have to debit the gain. And that's what they did over there. Okay, so that's the key issues. So that is basically normal change in ownership. The aspect over here that is specific relating to foreign operations is that of the FCTR. Before the change in ownership, the FCTR sitting in the group financial statements is basically FCTR relating to a subsidiary. So we have 85% of the FCTR. FCTR, foreign currency translation reserve. Now, at 30th June, we no longer have 85%. So what we're going to have to do, we first recognize 85% of the foreign currency translation reserve as at 30th June 2019. Okay, so remember, when a change in ownership happens, you first recognize the correct accounting treatment up until the change in ownership. So what did we have up until the change in ownership? We had a subsidiary. So therefore, we have to consolidate. So up until 30th June 2019, we consolidate. Consolidation means we're going to bring in 100%, but our portion of FCTR will be 85%. Now, after that is done, now we effect the change in ownership. So when we effect the change in ownership, we no longer have 85%. We now have whatever percentage we have. Okay, we'll see now. I'm not sure. So, so let's say we went from 85 to, let's say, 45%. Okay, I don't know. We'll have a look now. So now, because FCTR, the balance is sitting, the equity balance is sitting at 85%. It can no longer sit at 85% because we no longer have an 85% interest. So what we're going to have to do, we're going to have to make an adjustment so that it represents whatever interest we have, which is now, in my example, 45%. Okay, so that is basically the issue regarding foreign currency translation. When there's a change in ownership, the foreign currency translation before the change in ownership represented your original interest. But after the change in ownership, you need to make an adjustment so that it represents your new interest. So that is basically the key aspect. The other aspect we have to consider is whether we can convert the OCI into profit or loss, or whether we just do a, whether we just shift from, whether we move from FCTR, whether we do the transfer within equity, or whether the transfer can happen in the income statement. So remember, there's the key distinction. I don't know if you recall, in the statement of profit or loss and other comprehensive income. So this is what you do know. Okay, so in the statement of profit, loss, and other comprehensive income, you have two parts. You have the profit and loss section, and you have the other comprehensive income section. Okay. Now, the other comprehensive income section, OCI, has a few aspects that you may be aware of or you may not be aware of. So there's three important aspects. Is it two? Whatever. Okay, I cannot remember. What was I thinking? Yeah, so there's three important aspects when it comes to other comprehensive income, actually two, but anyway. So the one is that other comprehensive income can either be, presented net of tax or gross of tax. So other comprehensive income can either be presented net of tax or gross of tax. In this example, I think they gave it to us. Okay, no, it was another example I dealt with you guys. I think in the cash flow question, I dealt with that, where, remember, How do you know if something is net of tax? How do you know if something is gross of tax? So something is net of tax if they tell you it is net of tax. You don't see a separate line item called income tax. So I'm just talking about other comprehensive income. So if they give you other comprehensive income, when you look at it, you must be able to pick up whether it is presented net of tax or whether it is presented gross of tax. This plays a critical role in how you do a calculation. I think I dealt with it in the cash flow question. So just make sure if you don't remember, you just watch that part where I dealt with it. Now, the cash flow, the income, the OCI, like I said, can either be presented net of tax or gross of tax. It will be gross of tax if you see a separate line item under other comprehensive income called income tax. It is represented net of tax if you don't see a separate line called income tax. Net of tax means you will see revaluation, and the revaluation is already net of tax. You will see fair value gain on fair value through fair value gain on financial instruments, which they generally call mark-to-market reserve. That would be you'll just see one line item, and will be there's no separate income tax line item. That means that gain or that loss is net of tax. The moment you see a separate line item called income tax in the other comprehensive income section, then that means other comprehensive income is presented gross of tax. That's very important. That's the first thing. The second thing, is that I don't know if you saw, they're hard to bring it in, but here is an example, a situation. Here's a situation where they may bring it in. Okay, is that the first thing, the way you present other comprehensive income is that it can either be gross or net of tax. The second aspect regarding the presentation of other comprehensive income is that you'll have two sections under other comprehensive income. The one section is called items that may be reclassified, and the other sections would be items that may not be reclassified. Okay, so for example, an item that may not be reclassified is revaluation on PPE. So when you have a revaluation on land, once the land is disposed, you have actually now realized that that revaluation. So remember with land, while you're holding land and it's increasing or decreasing, that revaluation gain or loss is an unrealized revaluation gain or loss. There's no physical cash flow. The only time it becomes realized is when you sell the land. So let's say the land you purchased for 100,000, it is now sitting at 120,000. So that means the revaluation gain is 20,000. So that 20,000 is unrealized. But the moment you sell it for 120,000, that 20,000 now becomes realized. Okay. So when you realize that gain or loss, when you realize that other comprehensive income gain or loss, the accounting standard gives you two options how to treat it. It's not really an option, but basically it depends on what they tell you, but it can be treated in one of two ways. You either may reclassify that gain or loss, or you may not reclassify that gain or loss. Reclassify just means you can move it from OCI to profit or loss. So revaluation, the gain on revaluation, the gain or loss on the revaluation on PPE is one of those that may not be reclassified. That is why when you dispose of land, you don't move the OCI from OCI to profit or loss. You can't, because it is classified as an item that may not be reclassified. Now, but the reclassification that they do allow, we don't call it a reclassification, they allow for a transfer. What is the transfer? You may have seen it, you definitely have seen it, is where you move a revaluation surplus to retained earnings, where you transfer the gain in the revaluation to retained earnings. Why? When can you do it? Well, there's different options. The typical option would be when you dispose of it. So when you dispose of revaluation of the land, then the revaluation surplus on that land is transferred from a revaluation surplus to to retained earnings. Okay, so you must just be aware of that. Now, I can't remember with 100%, so I just need to read up again on it. But I think, if I remember correctly, FCTR is one of those items that may be reclassified. Okay, so that means it will affect the profit loss. I just need to confirm. So, but just be aware of that. So it's something you must be aware. You covered this for test 1 when you dealt with presentation of financial statements. They dealt with it under there. How do you deal with OCI? So OCI have those two specific issues. So just be aware of it. Okay. So what we're going to do now is we can actually do the journal entries. But before we do the journal entries, let's first draw a picture of what actually happened. Okay, so let's first draw a picture of what actually happened. So on your, for yourself, get a piece of page and then draw a timeline. So the timeline you have to draw is the current financial year where this took place. So the current financial year where this took place is the 2020 financial year. So draw a timeline where you're going to draw a line with with dots on two ends. So the first dot is the opening, is the beginning of the financial year, which is 1 April 2019. The last dot on that timeline is going to be, which is the end of that timeline, it's going to be 30th, it's going to be 31 March 2020. That is the end of the financial year. Then just draw in the middle of it. In the middle of that timeline, you draw another dot or another line where you will put in 30th June 2019. So under 30th June 2019, you will say change in ownership. Okay, so that is the big event. So from 1 April 2019, from the beginning of the financial year up until the change in ownership date, 30th June 2019, you tell yourself, what do you have? What do you have during that period? You have control, which means you have a subsidiary, which means you have to consolidate. Then from 30th June up until 31 March, from 30th June 2019 up until 31 March 2020, what do you have? You have significant influence, which means you have an associate, which means you have to equity account. Okay, so now you know. For the income statement purposes, that's how the income statement will look. We don't need this because we don't need this because we're not doing the income statement, but just to have that picture. Then make a circle at the end of just draw a circle at the end of 31 March 2019. That represents the balance sheet. So you need to ask yourself at 31 March 2019, 31 March 2020. So at 31 March 2020, that is the end of the financial year. That represents the balance sheet. You ask yourself at 31 March 2020, what do I have? What is the nature? What is the type of the investment that I have? The nature or the type of the investment that I have is an associate. Why? Because I have significant influence. So that means what will I have? What would the balance sheet look like? The balance sheet would look like, because I have an associate, because I have significant influence, the balance sheet will only have one line item called investment in associate. If it was a subsidiary, because we control, then how the balance sheet look? The balance sheet would have 100% of the assets and liabilities of the subsidiary on a line-by-line basis. But in this scenario, because we have an associate, we will only have one line item called investment in associate. That's not applicable to the scenario, but you just want to draw that up just to familiarize yourself with your thinking in terms of how to deal with change in ownership. What is the big event for us is 30th June 2019. So what happened on that date? Draw a short story for yourself or write a short story for yourself. What happened? it was basically a sub going to an associate. So that means what happened, you lost control. Because if a sub went to an associate, it means you lost control and you have equity, you have significant influence. So that means you have to dispose of the subsidiary. What does that mean? You have to get rid of goodwill, you have to get rid of NCI, you have to get rid of assets and liabilities. Okay. And then you have to recognize the gain or loss on the disposal. That gain or loss on the disposal will go through profit or loss. That is the part of getting rid of a subsidiary. Then you went from a subsidiary to an associate. So what does that mean? You're going to have to recognize an investment in associate. Okay, so that is basically what we have to do over there. So what I wanted to do now. Yeah, so basically I have to recognize an investment in an associate. Okay, so just take note of that. Try to think of something quickly. Yeah. So let's deal with this journal entry. Okay, so let's just deal with this journal entry. So now I'm going to open up Excel or Google Sheets, whatever it is, and then we're going to answer it. But while I open it, before we jump into the nitty-gritties, while I open it, just let me know if there's any question that you have. If there's no question that you have, just put in the chat, okay, or put in a thumbs up in the chat so I can see. So for everybody to respond, I just wanted to see if there's any question that you have at this point in time. Okay, so now let's deal with the journal entries. Okay, so remember the journal entry, what needs to happen at 30th June 2019. At 30th June 2019, we need to do at 30th June 2019, we need to get rid of a subsidiary. So that means at 30th June 2019, we need to de-recognize the sub. At 30th June, at 30th June 2019, we need to de-recognize the sub, which means at 30th June 2019, we need to de-recognize goodwill. We need to de-recognize net assets. We need to de-recognize net assets. We need to de-recognize goodwill. We need to de-recognize NCI. Now, what you should be aware of, that net assets is assets minus liabilities. So if they give us specific assets, if they give us specific liabilities, then you must get rid of the assets and get rid of the liabilities. But in our scenario, there is no assets given, there's no liabilities given. So what is net assets then? Assets minus liabilities is net assets. What is that then? That is equity. So that means we must get rid of all equity at 30th June 2019. Okay, so that is basically what we're going to do. But now remember, if you get rid of all equity, that means there's zero of that equity in the company. There's zero of the so if we get rid of the subsidiary, we're getting rid of 100% of the subsidiary. So once we put through the journal entry, once we debit the net assets, once we debit NCI, once we credit goodwill, that means there's no goodwill, there's no NCI, and there's no net assets, there's no equity of that entity in the group financial statements. But that is correct by getting rid of the subsidiary. We're getting rid of the subsidiary at 100%. But remember, we still have an associate. So that means we must recognize the associate. So when we recognize the associate, we must bring on the portion, our portion, we must bring on like the equity and so forth at that date relating to the associate. So just take note of that, because our balances needs to have our share of the associate and so forth. So just take note of that. We will deal with the nitty-gritties, but just keep in mind what we need to be doing. And then secondly, we need to recognize a gain or loss on the disposal. And like they had a gain, so we have to get rid of that gain, like in the same way that the group accountant did. So I'm just trying to pick up quickly from the scenario whether what the group accountant has is correct, or whether we need to just start it from scratch. Okay, because remember, they just said that the journal entries is incomplete. What we need to pick up, what we need to find out, whether the incomplete is correct, and we just need to fix up the rest. Okay. Okay, so what we're going to do, the journal entries. Okay, so let's go read the required. So let's go read the required. What does the required have to say? So the required says, assist the group accountant to complete the pro forma journal entries regarding the disposal of Endgame PLC on 30th June 2019. Provide any additional pro forma journal entries that are required to account for the disposal of a subsidiary on that date. Pro forma journal entries to account for the investment in the associate are not required. Journal narrations are not required. So all they want us to do is to deal with the disposal of the subsidiary, and they're saying the journal entries to account for the investment in the associate is not required. Okay, so just take note of that. So all they want us to complete the journal entries. So I guess we can start off with what was given. So let's complete the analysis of equity from 31 March, 1 April 2019 to 30th June 2019. Okay, so we can complete that now. Okay, so let me just quickly do this, delete. So remember what is happening from 31 March to 31 March 2019 to 30th 31 March to 30th June 20 from 31 March 19 to 30th June 30th June 2019. What is happening? We're only earning a profit or loss during that period. And then remember, in this scenario specifically, there's a loan, and the gain or loss on the loan is not yet included in the profit or loss. So we have to account for that. And then we just need to have a look if there's any dividends. They never mentioned of any dividends, so I doubt there's any dividends. So we will just complete that. Okay, so let's just have a look. So what I'm just going to do is do this. Okay. So remember, the current year is the new current year, if I can put it that way. The new current year is going to be 1 April 2019 until 30th June. 30th June. Okay, so we're just going to work through that. So remember what's happening for that 3 months, April, May, June. What's happening? We're going to bring in the profit for that 3 months only. Okay, then we're going to deal with the Forex for that 3 months only. And then we just have to have a look if there's any dividends. Okay, I don't think there was any dividends, but we can have a look if there was any dividends. And then what we will just do, we will have a look. we will then complete the account. We will then complete the analysis of equity up until that point in time. We will use that information to actually complete, we can actually use that information to work out some of the numbers. Okay, so let's quickly do that. So now we'll get the information. So I'm just going to do the same what I did over here. Okay, total equity. Yep. Okay, so there we're going to have, so now we're going to deal with that. So it's only the 3 months. So all of that information is going to help us to come to work out the disposal on the subsidiary. Remember, we need to get the numbers up until 30th June because we have to get rid of the subsidiary as at 30th of June. So when we get rid of Goodwill, we get rid of the Goodwill as at 30th of June 2019. When we get rid of NCI, we need to get rid of NCI as at 30th of June 2019. And when we get rid of the net assets, we need to get rid of the net assets as at 30th June 2019. Okay, so just take note of that. There's no dividends in this scenario, in this situation. I just put it in for completeness, but in an exam, you don't have to put it in if it's not applicable. I'm just showing you what I'm thinking about. So I know I must deal with profits, and I know I must deal with dividends. There's no dividends during the period 1 April to 30th June. There is profit for the year, but remember, we must only deal with profit for the year. So there mustn't be profit for the year, there must be profit for the period. Okay, the period is 3 months. Okay, and then the Forex on the loan for that 3 months. So let's deal with it. So if we go to the scenario, we'll have to find out what is the profit. Okay, so we will find out what is the profit during this period. So they gave us profit for the year. So you just have a look quickly. So where did they give us as profit? So here they say profit for the period 1 April 2019 to 30th June 2019 is 13,763. So they're giving us the profit for those 3 months. If they gave us profit for the entire year, then you'd have to say, let's say that 13,763 was for the entire year. Then you'd have to say 3/12 to get the 3 months. But that is the 3 months, so we can plug it in as is. So profit for the year in foreign currency, 13,763. Now remember that 13,763 over here is and it's million, but we're working in the rand thousands. Okay, so just take note of that. Okay, so just be aware of that. Now we need to deal with the Forex on the loan. So now we need to deal with the Forex on the loan. So the question is, how are we going to get the Forex on the loan? So basically, we need to get the foreign currency amount at 31 March 2019 and the foreign currency amount at 30th June 2019. So let's have a look. So remember, if I just work it through here, so I do the, I'm going to use the same information. So I'm on the opening balance on 1 April 2019, and then the closing balance I won 30th June 2019. Now I need it in foreign amount, right? I need it in foreign amount. That's what I want it in. So 1 April is the same as 30th June. I mean, 1 April 2019 is the same as 31 March 2019. So I'm just going to say equal to that. Okay, how did we get this amount? So remember, it was the Rand value divided by, so the Rand value at 31 March 2019 divided by the exchange rate at 31 March 2019. Now, there was no change in the balance on 30th June 2019. So the Rand value is still the same, 50, what was it? The Rand value is still the same, 56,580. So the Rand value is still the same, 56,580. And to get the foreign amount at 30th June 2019, I divide by the exchange rate at 30th June 2019. So what is the exchange rate at 30th June 2019? Let's have a look. I don't know. 1 Rand 70. Okay, 30th June 2019. No. Yeah, so I must use the average. So so just take note, we need to use the average rate at 30th June 2019, because remember what's happening. 1 April 2019, we had the closing rate. So it's correct to use the closing rate at 31. It was correct to use, where are we going? I want this rate over here. Okay, so we're going to use the 170. So remember, what we're trying to get, we're trying to translate the loan at 1 April 2019, which is the same thing as 31 March 2019. Then we want to translate the loan at 30th June 2019, which is the closing rate at 30th June 2019, and that is why we use the 1 Rand 70. So just take note of that. So you have dividing 170, which is the closing rate at 30th June 2019. So so take note of what happened over there. So just take note what happened over there. Okay. So the question you need to now ask yourself, is it a gain or is it a loss? So we are looking this from the subsidiaries point of view. Okay, we're looking at the impact on the subsidiaries equity. If they had to pay us, at 1 April 2019, it would have cost them 29,000 ZMK. If they pay us but now that they didn't pay us at 30th, at 1 April, if they now have to pay us at 30th June, it's going to cost them 33,000. So as you can see, it's costing them more at 30th June 2019. So that exchange difference is an exchange difference loss. So it's a forex loss. Now, a forex loss, what is it? What does a loss do to profit or loss? It decreases profit or loss. So that 3503, it is going to decrease the profit. Okay, just take note. You might just think through it. Just do here now. You must just think through this over here. Where's this now working for? You need to just, doesn't mean it is positive, it's an income, doesn't mean it is a loss, it is a gain. You need to think through the perspective, what's happening over here. So just take note of that. Make sure you understand why it is a loss or why it is a gain. It does not mean it's positive, it's a gain. It does not mean it's a negative, it's a loss. It all depends on the perspective. So here, what is happening? If at 1 April, if they had to pay us, it would cost them 29. But we are 30th June, so now it is costing them 33. So that means they are paying more. So that means it is unfavorable for them because they have to pay us more. So to them, it is a loss. This same scenario could have been a gain. If it was other way around, they mustn't pay, they must receive. If at 1 April, they had to receive an amount, they would have received 29. But now, at 30th June, they can receive 33. So as a result of that, they would be receiving more. So that means this amount would be a gain. So it's very important to understand, okay, the perspective. Don't just think positive income, negative loss. Look at the perspective. So because they have to pay more, it is a loss. How do we know it's a loss? Because they have to pay more, their liability is increasing. The liability, so because they have to pay more, the loan balance is increasing. The loan balance is a liability, therefore liabilities are increasing. A liability increase on the credit side. For every credit, there must be a debit. The debit is to Forex profit or loss from their perspective. Okay, we're not talking about a group now. So their perspective would be debit to profit or loss. A debit to profit or loss is debiting equity. A debit to equity is a loss. Okay, so a debit to equity decreases equity. So therefore, this is a decrease to the equity. So just take note of that. Okay, there is no dividend, so that is fine. Okay, so total equity before FCTR would be the sum of all of that. So that is total equity. Remember, there would be no FCTR in the foreign amount, it only as a result of foreign exchange. So therefore this we can just add up as well. There will be no, FCTR does not apply to the foreign currency column, okay? The foreign amount column, okay? So just take note of that. Now we apply the Forex, okay? So now we apply the Forex. So because this relates to P&L, profit or loss, P&L relates to a period of time. This period of time is 3 months. So the exchange rate we use is the average exchange rate for that period. So let's go have a look. The average exchange rate, average for the 3 months ended 30th June 2019 is R1.55. Okay, so that is R1.55. So here it's 1.55. The Forex, is also for that 3 months. So we multiply by R1.55 is nothing. So I don't put in anything over there. Okay. Okay, nothing over there. Okay, the rate we're going to use over here is the closing rate. So the rate we use over here is the closing rate. So what is the closing rate? Let's have a look. The closing rate at 30th June 2019 was R1.70. Okay, so remember we dealt with that earlier, R1.70. Now we can get the total, the 100% ZAR amount. It is simply going to be that multiplied by exchange rate. So now we add this up. We get to 332. But now remember, this amount must equal, this amount at 332,260 must equal 176 multiplied by the closing rate, which is 300. So as you can see, we're currently sitting at 332, but it needed to be at 300. So there's a foreign exchange loss over here, and we need to split that foreign exchange loss between Goodwill and then FCTR, then the remaining FCTR. So remember, the total FCTR is basically a loss of 30,000. Okay, so it's a loss of 31,000. So the total FCTR is a loss of 31,000 Rand. Okay, but that 31,000 Rand, it will be split between Goodwill and then everything else. Okay, so just take note of that. So now we're going to do that split. So let's try and, so let's, if I can ask you to take 7 minutes to work out the split between this FCTR between Goodwill and the normal FCTR. Can I ask you to try it? So take the number 31762. I'll show you how I did it over here. So you can use that workings, the setup. You can use the setup as an example. So please take about, please try to take up until half past to work it out. And then I'm going to do it with you. Okay. Are we okay with that? Please take the next few minutes to just quickly work through it. Are you guys done? Okay, let's quickly work through it. So the way we're gonna, so that 31,762 is not a difficult calculation. We simply just need to split it between Goodwill and FCTR. Okay. So I'm not going to do it the long way. I just did it the long way over here. So to show you the thinking, where was it now? So working 5 and working 6. There's no need to do it the long way, okay? I just did it the long way just to show you my thinking, but now I will do it the quicker way. So remember what we want to do. All we want to do, we want to compare we take the foreign currency goodwill amount. So the foreign currency goodwill amount, goodwill did not change. So the foreign currency goodwill amount is this 21,139. Okay, so it is the 21,139. Okay, and we're going to multiply it by the movement in the exchange rate. So the way we get the movement in the exchange rate, we take the latest exchange rate, which is the closing rate at 30th June 2019, which is 170, and we subtracted from the exchange rate. We subtracted from the exchange rate at 30th June 2019. Okay, at 31 March 2019. Let's have a phone call quickly. Can I just quickly take it? Just 1 minute. Your call has been placed on hold. Okay, it just continues along while I'm just waiting for that person. So what we're going to do with the FCTR in Goodwill, we take the Goodwill balance, which is the foreign currency Goodwill balance, okay, which is the 21,139. Then we multiply it by the movement in the exchange rate. We multiply by the movement in the exchange rate for that period. What is our period? 1 April 2019 to 30th June 2019. So you start off with the last date, which is 30th June 2019, minus the first date, which is 1 April 2019. Sorry about that quickly. Just had to sort out miles appear to be urgent. So what we're going to do over there, so where was I? It was this calculation. So over here, so remember in the one above, I did a long calculation just to show the thinking. But in an exam, you don't want to do the long calculation. It's a waste of time. You simply do it as quickly as that. So how do you do it? You take the goodwill amount, foreign amount. The goodwill is not really going to change. It can change through an impairment, but I don't think they will bring that in. But basically, you take the goodwill amount, which is 21,139, and then you will multiply by the movement in the exchange rate for the period. So our period is 1 April to 30th June 2019. You start off with the closing rate, which is 30th June 2019, which is 170. And then you subtract it from the opening rate, which is 1 April 2019. Remember, 1 April, 31 March 2019, the same thing. Okay, so that is basically what we will get over here. So we will say 21,139 multiplied by opening and closing rate minus opening rate. Sorry, got it the other way around. Closing rate minus opening rate. Okay, so the goodwill is going to be that. So basically, FCTR is just basically going to be the difference, which is that minus that. Which is negative 27,534. Okay, so just take note of that. So now if you do that check, basically the sum of these three minus that must give you naught. Minus that must give you naught, so now you know you are sorted. Okay, so just take note of that. So remember, it's important to separate this. It's important to separate what we're happening over here. Okay. So now, let me just see the question. Okay, so did you get that numbers? There's nothing complex. So you're happy with that. Okay, so now we have all the numbers we need. Not exactly. So now we just need to do the split. 85, 15. So this is going to be that times 85%. And this is going to be equal to that times 15%. So now I can just drag this down. Take note, you don't have to take note, you don't have to have the dividends line item. I just brought it in. So for completeness purposes. So if I add this up, so our equity would be that. That would be this. And then same. So remember, for goodwill, because we are using the partial goodwill method. And how do we know we're using the partial goodwill method? Because NCI is measured using the net asset, the proportionate method. Okay, so because NCI is measured using their proportionate share, that means we're using the partial goodwill method. So therefore, all the goodwill, all the forex, it belongs to the parents. If NCI was measured using the fair value method, then that means we are using the full goodwill method. Then you split the goodwill between parent and NCI. Okay, and then the rest will be split. that times 85%, and then that multiplied by 15%. Okay, so remember, the FCTR includes goodwill and everything else. What is everything else? Everything else is basically like your normal profit or loss and so forth. And that is why we need to split between what belongs to goodwill and what belongs to goodwill and what belongs to everything else, because everything else is like your profit or loss and your OCI. And in that, the NCI and the parent share. Now, when it comes to goodwill, NCI and the parent don't always share. If we're using the full goodwill method, then NCI and the parent will share, and there's no need to split between goodwill and normal FCTR. You can just have one FCTR line item. But the moment you're using the proportionate share, the moment your goodwill is using the partial method, then you have to have two FCTRs, one specifically for goodwill and one for the remaining of FCTR. So like my recommendation is to avoid having to still think about that, just always split between FCTR goodwill and normal the remaining FCTR. But just take note, the only reason why we're splitting between goodwill FCTR and normal FCTR is because goodwill is measured. Goodwill, we're using the partial goodwill method. If we were using the full goodwill method, there was no need to do the split. So why do we do the split in this case? Because for normal FCTR, we split 85-15. But when it's for goodwill, we owe everything belongs to the parent. But the moment you use the full goodwill method, then this would also have split 85-15. And there was no need to separate the two FCTRs. So just take note of that. Okay. But like I said, to avoid any confusion, just always do the split. Okay. So remember, total NCI is going to equal that plus that. Okay, so total NCI is 81, which is that NCI over there plus the 3 months, which gives them a total NCI of 81,000 Rand. Okay, so now we need to do the journal entries. I just want to read this, the required again. So the required says, assist the group accountant to complete the pro forma journal entries regarding the disposal of Endgame on 30th June 2019. Provide any other additional pro forma journal entries that are required to account for the disposal of a subsidiary on that date. Pro forma journal entries relating to account for the investment in the associate are not required. Journal narrations are not required. Okay, so what we're going to do, we're going to have to do the okay, so remember, the journal entries that we're going to have to do in order to account for the disposal of the subsidiary would also need to, what we first going to have to do is account we're first going to have to account for the journal, for the consolidation journal entries for that 3 months. So we're first going to do normal consolidation, and then we're going to have to deal with the disposal. Okay, so let's just quickly have a look. So just take a look at this quickly, okay? What we're going to do, so remember the way the consolidation works is that for consolidation, we recognize 100% of we recognize 100% of assets, liabilities, income, and expenditure. Okay, so just take note of that. Now, when we have a disposal, one of the easiest ways to deal with it is as follows. We recognize all the consolidation relating to the parent, all the income and all the expenses. So basically all profit or loss and all, so recognize all profit or loss as well as all OCI. We take it, where do we take it to? We take it to the investment in the subsidiary, or in this case, they just call it investment in Endgame. So once we take all journal entries to the investment, then we just de-recognize the investment, which will then account for everything. So I'm gonna, what they do is the following. They do one massive journal entry. I'm not going to do one massive journal entry because it might be a bit too confusing. So what I will do is, I'm going to do it in smaller journal entries. Okay, so we're going to have multiple journal entries, but it's in smaller. So each small journal entry will most likely be easier to understand. Then what I want you to do after this on your own, not with me, on your own, is to try to understand then you go to their solution, right? You go to their solution and you compare our journal entries to their one massive journal entry. Then you can see if you can try to understand what's happening. So you kind of need to spend probably a good 90 minutes just understanding this journal entry. So then try to make a half-page write-up for yourself and try to understand it. Then you contact me. Okay, so then you can just email me. I'll tell you where to email me, and I'm going to read through it. Right. So if you can do it by the end of Sunday, so that Monday morning I can read everybody's responses, and then I'm going to take then I'm going to try to find a common thread in terms of what is the common issues and so forth. And I will either send a voice note or I'll do a write-up. So you have it's your decision how you want to do it. There's 3 ways you can respond to me, right? So it depends on what's easiest for you and what you prefer. So but you need to email it to me because it's easier for me to keep track of it there. So one way you can either write out your understanding and any confusion. It's not going to be easy to understand, right? That's why I say dedicate a solid 90 minutes to see what's happening. So you can either write out your response in terms of what you understand and anything that is confusing to you, or you can create a video, just like a selfie video, and you explaining to yourself and you send me the video, or you just send a voice note. But whatever method you do, you need to email it to me. Then I will go through it Monday morning. Okay, so I'm going to dedicate 2 hours to go through it. So that is why if you're sending me a video, or if you're sending a voice note, it'll come be a 2-hour voice note or a 2-hour video. Okay, so like try to keep it like nice and short, 10 minutes. Okay, so that I can easily just work through it and then find the common thread. Then I will write up something, or I will send a voice note myself to explain, to clarify any common issues. Okay, so that's what you're going to have to do. So I'm going to do the journal entries, but I want you to work through my journal entries and their combined journal entry, and then see to see if there's anything. And then I will respond to your queries in that way. So this exercise may seem extra work, but it's going to, and it may seem long, 90 minutes, but it's really, really going to make a significant difference in your understanding if you try to grind through it. Okay, so let's go do the journal entry. So there's no order, everything happening on 30th June 2019. Okay, so what I'm going to do, I'm going to recognize what we just did over here. Okay, so what I'm going to do, I'm going to recognize what we dealt with over here. So I'm going to deal with this line item to record that line item. Okay, so remember, so let's have a look how we're going to deal with that. So remember, we recognize 100% of income expenses. Okay, so we recognize 100%. When you consolidate, we recognize 100%. So for that, we're going to recognize 100% of the profit. So remember, included in the profit or loss from the that was given to us, the what's the name, the group accountant did not recognize anything. Okay, so actually, let me start this way. The typical way of dealing with a consolidation is basically the following. You have your starting point and you have your end point. You need to understand what is your starting point and you need to understand what is the end point. Okay, and once you know what is the starting point and you know what is the end point, you can then do your pro forma journal entries. So your thinking must be, in order to do pro forma journal entries, I must know my end point and I must know my starting point. So what is my end point? My end point is the group financial statements. Okay, so the group financial statements is 100% of the subsidiary, assets, liabilities, income and expenses on a line-by-line basis. It is 100% of the parent, income, expenses, assets, liabilities on a line-by-line basis, and it is only our share of an associate. Okay, that is the group. But the group must be from a group perspective, meaning any intercompany transactions needs to be eliminated, and any fair value adjustments at acquisition needs to be accounted for. So that is the end point. The starting point is as follows. What is our starting point? Our starting point is the separate trial balances of the parent and the subsidiaries. So our starting point is the separate trial balances of the parent and the associate. And of the parent and the subsidiary, nothing of the associate. Now, that is your typical starting point. Your typical starting point, 100% of the parent, 100% of the subsidiary, of their separate trial balances as at the end of the current reporting period. Then we want to get to our end point, which is the group financial statements, as I explained. So any differences we need to account for using journal entries or pro forma journal entries, and pro forma journal entries goes through 3 phases. Phase number 1, at acquisition journal entries. Phase number 2, since acquisition journal entries. And phase number 3, current year journal entries. That plays a significant role. You have to go through those phases. How you go through them, it doesn't matter, but you need to go through those phases. So that is a typical approach. We need to understand what's happening in this scenario. In this scenario, we only have trial balances as at 31 March 2019. Okay, so we only have trial balances as at 31 March 2019. We need to account for this change at 30th June 2019, but the group accountant has no clue what needs to be done. Okay, so he only prepared a draft statement, a draft journal entry. So there's no journal entries actually processed. So we can do our own journal entry that we need to do. So what is our starting point? The starting point have nothing of the foreign sub. So typically we will have typically the starting point would have 100% of the foreign sub. But in this case, the starting point is 0 of the foreign sub. So that means we need to bring in the foreign sub. So that is the critical part. You need to know what is my starting point. Your typical starting point would have been 100% of the foreign sub. But because there is nothing of the foreign subsidiary, we need to bring the foreign subsidiary in. And that is why we're going to do these journal entries. So to bring the foreign subsidiary in for those 3 months, we need to bring in 100% of the foreign subsidiaries' income and expenses. But because we don't have 100% of the foreign subsidiary income and expenses, we will just bring in certain line items. So what represents 100% of the foreign subsidiaries income and expenses? It is going to be that profit or loss line item. So because they made a profit of 21 million Rand, so as you can see over here, as you can see, 100% of profit or loss is 21 million. So we need to bring that on because there's nothing in our starting point. We want it in our end point. So therefore, we need to bring on the full 100%. Typically, this amount would have been included in your starting point. Why? So typically, your starting point would have had the 21 million because you'd have had 100% of the subsidiaries trial balance. But we don't have the subsidiaries trial balance. So therefore, our starting point in this scenario is 0. But we need it to be 100%. So we're going to bring on that 100%. So one set of journal entry is going to be profit for the year. The funny part of this is that there is no account called profit for the year. So that is the challenging part. You don't have an account called profit for the year because profit for the year is made up of income and expenses. Okay, so sales, cost of sales, and so forth. So in reality, you'd have to go process everything against sales and expenses, but we don't have that. So we just assume there's an account called profit for the year, and profit for the year is a P&L account, and we take in the amount we calculated, which is the 2133. So this is obviously from the analysis of equity during the period 1 April to 30th June 2019. So we're bringing on 100% of the subsidiaries profit or loss. Now we must say, okay, who does it belong to? Okay, so who does it belong to? So by leaving it in over here, that means we're going to get 100%. The parent is going to get 100%. But does the parent have 100%? And the answer is no, the parent don't have 100%. So we need to give the portion, we need to reduce profit or loss. Okay, so we need to reduce profit for the year by the NCI's portion. So what do we call it? We call it NCI P&L. Okay, so we call it NCI P&L. NCI P&L is a profit or loss account. So by doing this journal entry, so that now means that profit for the year in the group financial statements is 100%. That is correct. Okay, because the starting point was 0. We want it to be 100, so we bring in the 100. But now we say, actually, we don't have a full 100%. So we need to reduce that with the NCI's portion. And we only want to reduce P&L. So therefore, we have NCI P&L, and we go fetch whatever the NCI's portion is. So what is the NCI's portion? The NCI's portion is, if we, the NCI's portion is that over there, the 3.2. So we reduce our portion with the 3.2. That is the NCI. But as you can see, this journal entry does not balance. This journal entry does not balance. If I add it up, this journal entry does not balance. So where do we take it to? So where do we take this amount to? Well, because we are dealing with a change in ownership and is a loss in subsidiary, we will take it to the investment account. So the investment account in this scenario was called investment in endgame. Okay, so we will take it to investment in endgame. Investment in endgame. And this is a statement of financial position balance. So why are we taking into investment in endgame? We're just going to either increase the investment with whatever profits the parent is making, and we're going to reduce investment in endgame with whatever losses the parent is making, so that in the end, we have a total investment that we will just simply de-recognize. Okay, so the balancing figure is going to be what the difference between the two, but basically it's going to equal the parent's portion of 18,133. 18,133. Okay, so that is recognized, bringing on 100% of the profit for the year. We have to bring on 100% because for that 3 months, we have to consolidate. So we bring on 100%. There was nothing in the starting point. So therefore we need to bring on 100%. If we had something in the starting point, all we would have done is process this journal entry. We'd have reduced profit for the year by 3.2, and we'd have taken the other to we'd have taken it against NCI. Okay, so just take note of that. But because there's nothing is sitting in the investment in endgame, so we have to adjust the investment in endgame. So just take note of that. So all of this is coming from, so this is all from working 3, which is the analysis of equity. Okay. Now the next journal entry that we're going to do. So the next journal entry that we're going to do is the following. So the next journal entry that we're going to do is to account for the disposal. Okay, we're going to get rid of the investment in the end game, and we're going to recognize the investment in associate, and we get rid of we must recognize the loss on disposal, and we must recognize the gain on disposal. Okay, or eliminate the gain on disposal. So what we're going to do over here, we must get rid of the investment in endgame. Okay, so we're going to get rid of the investment in endgame. So we're going to get rid of the investment in endgame. So there's going to be a credit to this. It will just be the balancing figure. Okay. What we're going to recognize, we're going to recognize investment in associate. The investment in associate was just the fair value of the remaining interest. Okay, so the investment in associate is simply the fair value in the remaining interest, which was given to us as 75 million. You can just look over there, 75 million. So 75 million 124. Okay, 75,124,000. We're working in rand millions. So therefore, we will just keep it as is. Okay. Then they said they were we saw in the journal that they made the parent in the separate books made a gain. Now the group does not want the parent's gain, so we need to eliminate the parent's gain. So what? Because remember, we have the parent's book, we have the parent on our books, so therefore the parent would have made a gain when they dispose of a situation. So in the parent's numbers is a gain. The group does not want it, so therefore we need to eliminate it. So we will just say gain on disposal, separate books. Okay. So then that is a P&L number. So the gain that the parent made would have been a credit balance. So to eliminate it, we need to debit it. We can simply use what the group accountant calculated, and he calculated 17.6 million. Then they told us that the group made a loss. Okay, so here we know it is a loss on disposal. A loss on disposal. This is the group books. Okay, from the group perspective, and that will go to P&L. Because they made a loss, we need to recognize it as a loss. So remember with the gain on disposal from the separate books, from the gain on disposal in the parents' books, the group don't want it. So included in profit or loss is a gain which increased profit or loss. Because we don't want it, we need to eliminate it. So therefore we debit it. With the group, this loss on disposal, we want to recognize the loss. So therefore we need to recognize a loss. A loss is recognized. An increase in an expense is recognized on the debit side. So that is 36,090. All of this impacts the investment in Endgame. So that means we will just, investment in Endgame will just be credited with all of these. Well, there's no need to work out a there's no need to sum up on the line, because we already said we're equaling it to all of it. So just take note of that. Now, there's some more journal entries we need to process. What you must know is the following. I'm taking it all separately to investment in Endgame. What they would do in their journal, they have a combined journal entry. So all of the journal entries I'm going to do, they would have it in one. So that means here you can see I have an Endgame debit. I have an Endgame credit. I'm going to do some more, and then I'm going to have some more Endgames. They would have one line item called investment in Endgame, which will be that minus that, whatever. So you get a net figure, but they will have all of these other line items all in the journal entry. So just take note of that. So make sure you can understand what's happening. Try to figure it out. Spend a good 90 minutes. Then after 90 minutes, whatever you know, if you want to spend some more time, you can. If you take less than 90 minutes, that's fine. But spend at least 60 minutes on it. Try to figure out what is happening, and then write up your understanding of what's happening, and then any confusions that you have. Write it up, create a voice note, or do a video, whichever one you are comfortable with, and then you send it to me. Okay, then I'm going to look through it, and I will draw up a document or a voice note, whatever, that will explain the typical areas of confusion and to clarify anything else. So that is that aspect. Okay, so now let's continue. So we're halfway through this journal. We accounted for 2 aspects of the journal. Okay, now what we need to do, we need to bring through the FCTR. Okay, so now we need to bring through the FCTR. No, not the one relating to Goodwill, we'll just the normal one. So FCTR, if we go to this over here, where's FCTR over here now? Okay, now we're going to bring through the FCTR. Okay, so what we're going to do with FCTR, FCTR is basically equity balance. Okay, so FCTR is an equity balance. So what we're going to do is the following. So with the journal entry, we're going to do the following. FCTR. So remember in journal entries, you can't use abbreviations, right? You must write out the full. However, I do think FCTR is one of the very handful of abbreviations that you can use because everybody know what FCTR is. So there's no need to write out foreign currency translation reserve, okay? And I think the same thing with NCI. Everybody knows NCI, so therefore in the journal entry, there's no need to write out non-controlling interest. You can say NCI. But those are basically the only two that I can think of that is allowed. Every other thing you must write in full. Okay, but you can check whether UNISA marks if you say FCTR and whether UNISA give you the mark if you say NCI. But if I remember back to when I was in studying, I think the two, FCTR and NCI, and I think PPE, those three was allowed to just say PPE, NCI, or FCTR and not write out the full because everybody knew what that related to, but anything else needed to be written out in full. Okay, so FCTR is statement of changes in equity. So remember, in FCTR, it will go to NCI and it will, so we'll give NCI their component, NCI, OCI, and we would then take the other part to investment in in-game. So everything, because what we want to do, we want to get the investment in in-game balance so we can get rid of it. Okay, so that is what we are doing over here. So let's have a look what's happening. So for FCTR, we're recognizing what happened to FCTR in the current year. Okay, so have a look over here. Remember, FCTR is going to be those three, but also the Forex on the loan. So just take note of that. The FCTR is going to be the normal FCTR on Goodwill and the normal FCTR, but don't forget, you will also take the exchange rate on the Forex loan. Why? Because the loan forms part of the investment. If the loan did not form part of the investment, there was no need to do that. So please just take note of that. So let's just highlight that in, which color did I use last time? That, yeah. Okay, so just please be aware of that. So, so FCTR is going to be the sum. So we know it's a loss in the current year, so therefore it's a debit, which, what am I doing? It's going to be that plus that plus that. So because it's a loss, it's a debit, but remember journal entries is not negative or positive. Debit or credit represents negative or positive. So it's going to be 37,190. So now we just give what belongs to NCI. So we take NCI, you just take straight from the statement of change from the analysis of equity. That is NCI. Once again, it can't be a that, and the difference just goes. The difference just goes to investment in in-game, and I can show you how we get it. So here you can see that is 33,062. What did I just do over here? Okay, so there we go. So this is just basically the balancing figure. So please make sure that you get that part, and this is going to be OCI. So let's just explain this journal entry. So this year, Actually, this is not OCI, this is OCI. So this over here is the movement in OCI for the full year. I mean, for the 3 months. So remember, the group financial statements needs to show FCTR OCI at 100%. That's what they're doing over here. Okay. The 100% FCTR was the Goodwill FCTR, the normal FCTR, and the Forex on the loan. The reason why the Forex on the loan is included in FCTR, because the Forex on the loan is considered to be part of the investment in subsidiary. Okay, so that is why it's included over here. Because it was a loss, that means OCI is decreasing. OCI decreases on the debit side. Okay, so that's what's happening over there. But if we have it like this over here, in the same way we dealt with profit over there, by leaving it at that, we're saying all belongs to the parent. Okay, so that is why we're saying, okay, actually we should give NCI their component. So we gave NCI their component, and the remaining balance goes to investment in Endgame. Same thing over here, the remaining balance goes to investment in Endgame. So just take note of that. Okay, so this is all coming from working 3. Okay, so the last thing we need to do, I'm just going to delete this line item. So I needed to show you, so that's fine. So the last one we're going to do is just recognize the opening balance. Okay, so we need to recognize all the opening balances. So the opening balances we have from part A. So we would be able to get the opening balances from part A. But basically what we need to recognize for opening balance is the FCTR, the opening balance FCTR for the parent, and the opening retained earnings for the parent relating to the foreign operation. Okay, so we will be able to work that out. So remember, the opening FCTR is last year's closing balance. So in part A, so let me just see if we can find it in our working over here. So here you can see opening retained earnings relating to the subsidiary is at 11,097. It was the profit for the year less the dividends. So it's 11,097. Okay. So what we're going to do, we're going to have retained earnings. This relates to the opening balance. Retained earnings, I'm just going to put the opening balance. It is SCE. It is going, I'm going to just put in the working, which is equal to the sum of. So it's the opening balance of retained earnings relating to the subsidiary from the parent's perspective. So it is those 2 line items over there. Okay. For FCTR opening, FCTR opening is also SCE. Remember, all the FCTR from the parent's perspective relates to the foreign operation. So we can just go fetch it from working, wherever we did it, the working. I don't know where I did that working. Workings. So basically you can go, I'll just go fetch it from working 7. Okay, so it's working 7. So it's the full balance, because remember, all of it relates to us. Then the difference is going to go to investment in Endgame. The difference is going to go to investment in Endgame, which is going to equal the sum of those 2. Okay, so that is basically those journal entries. So these journal entries is what they were looking for. Okay, so these journal entries is what they were looking for. So I'm going to stop over here. Then I want you on your own, whenever you want to do it, over today and tomorrow is to work through this journal entry and to also work through their combined journal entry. Try to gain your understanding and then write up what you understand, write up what you are confused about, and then send it to me. On Monday morning, for about 2 hours, I'll work through the various responses, and then I will create something that will provide clarification and that will provide some feedback so that we can make sure everything's on the right page. Because what you're going to have to deal with, you're going to have to be able to deal with a situation of this nature. Okay, so I'm going to stop over here. Is any quick questions that you have? So I need to go in the next 3 minutes. So it's any quick questions that you may have. Let me know quickly. Anyone? Is there no questions? Okay, there's nothing, you guys are good to go. Then please work through it and try to send me by Sunday night, Monday morning. Monday morning, I'm going to work through, I'm going to book time in my calendar to actually work through the responses and then provide you with some clarification. Okay, so I'll stop there then. And I'll see you guys tomorrow morning for Mac. Okay, bye-bye.